we progress forward, I would like to talk to you a little bit about some of the obvious changes. I'm going to start off with the change in board. Our board of directors hired a third-party firm to help us recruit a new NED and select a new chair. I was not on the NOMCO, but over a period of time we did that. And this week we announced two things. First is that Rob Woodward, who is our new chair. Rob has been with the board since 2013. He has a wealth of TMT knowledge, so very helpful to us. Great for me because he knows our business. And we're very, very glad that he's taken over that role. So congratulations and thank you, Rob. We've also been very fortunate through a recruiting process, and we're flattered to have Philip Rogerson join our board. Philip is chairman of Bunzl and De La Rue, clearly a big name in the UK, and we're very pleased that he would consider joining us. And you know, just a very exciting man, and happy he's part of the team and helping us grow. The second issue probably to address straight away is our Chief Financial Officer, Keith Butcher, has left. There's nothing really new to add here other than what we've already said. We wish Keith well. There are no disagreements and no changing in accounting practice. It was a time to change, and we wish him the best. As we move on, this presentation, we're for the first time going to talk to you a little bit about the second side to our business. First, our core business, data erasure, which we'll go through in a bit of detail today. The second is our newer business called Device Diagnostics. This was the acquisition of a company called Excalibur. It is now into our revenue number. We'll talk to you a little bit about what that means, types of customers that we've been able to see, and how it's growing. At a high level, at the end of the year, we finished at around 277 employees. You won't see us grow much from here. There were a lot of salespeople added there. You'll see us finish the year in around 285. We have 23 sales offices around the world in 15 different countries. We are chasing an addressable market that's very large, close to $4 billion. And as legislation continues to kick in around the world, we will continue to take advantage of that opportunity. We have two key development centers in the world. One is in India, Pune, India, and the other is in Joensuu, Finland. So both very stable, high-quality environments. On the financials, we did experience double-digit revenue and profit growth for the period. As most of you know, we are an AIM-listed company with about 58 million shares outstanding. We will confirm our consensus revenue growth of 41% for the year and our AOP margin of 26% on the year. This slide we like to show, as people are maybe not always as familiar with our business. We try to give you a sense of what the revenue growth has been like over many years, not just the few years that I've been here. We want to confirm the consensus revenue of £32 million for the year. Again, the 41% revenue growth rate. We did experience 97% gross margins on the half, and our AOP margins are being confirmed at 26% on the year. The other thing we'd like to talk a little bit about, and if you've seen me present before, you would have seen these 5 subjects as our internal and external commitments. The first one is maintaining our growth rates associated with the ITAD. We maintain committed to that, and we continue to do a very good job there. The second is growing USA, North America in general. You'll notice that from the origins of my days at this business to today, we finished the half North America at 42% of our revenue stream. So we're very proud about that. New technologies. Our mobile business grew at 44% in constant currency on the half. And leveraging our scale. Having offices in 15 countries is kind of unique for a business our size, and it's allowing us to expand our footprint. Just recently, we received our licenses to be able to sell in China. Literally in the last 2 weeks, we're very excited about that opportunity as well. And last, we've got some great sales leaders with Steve Holton and marketing leaders like Annie Wacker, and we're looking at those two to help us leverage growth going forward. So through a few quick summary items. Our revenues were up 43% on the half, 28% in constant currency. Our annual operating profit was up 33%. We grew in all of our product lines. We had a good strong recovery in Europe. New leadership, Alan Bentley in Europe, and getting on full manpower has allowed that business unit to grow at 21% in constant currency. So it's a big turnaround from roughly 8% the last reporting period. We also had an interesting change in the business. We did over 40 transactions that were 100,000 pounds or greater on the half. That's up from less than 10 the same period previous year. So you can see our business is shifting very much to the enterprise and larger transactions, which we're very excited about. We do have a large unpaid debtor from a government contract in Mexico that is starting to be paid now, so we're excited about that. It's unfortunate that it was unpaid. We normalize our cash conversion rates at around 81%. And going forward, for two primary reasons, you'll see those normalize at between 80 and 90%. The first is enterprises don't prepay. They pay in 30, 60, or 90 days. And we are now embarking on a channel program, and the channels don't prepay either. They pay in 30, 60, or 90 days. So being realistic, we should see between 80 and 90% cash conversion rates. We also spent some money in the half. We have a series of joint ventures around the world in different countries, and we've been on a buyback process. Places like Australia, New Zealand, France, and Southeast Asia based out of Kuala Lumpur were bought back in the half. The real benefit to us as a company is consistent with our sales force projections, and we also get to take the full amount of the bottom line into the business. So again, pretty exciting there. We've talked a little bit about the board changes. We have recently added Mr. Simon Herrick as our interim CFO. His most recent, he was CFO from Debenhams. He's been helping smaller companies and other companies go public over the last couple of years. He has joined as our interim for a minimum of 6 months to help us find a replacement for Keith, and we're very glad to have him. He's been with us all week on our roadshow. Also, we added several senior members to our leadership team. In the first half, Steve Holton joined as our President and Chief Revenue Officer. Steve was the Chief Revenue Officer at Good Technologies, which was bought by BlackBerry, responsible for building that organization. He was also at Right Now Technologies, responsible for building that organization. So we're glad to have him. And Richard Steenan is a very well-known author, former Gartner analyst, Chief Marketing Officer at companies like Fortinet, and a longtime consultant. He's got a big voice with the Chief Information Officer and Chief Information Security Officer communities. Again, glad to have him on board. A couple other notable items in the half, and then we'll move on to Chris Hunter. We can talk through some financials. We invested in 28 salespeople in the half. 12 of those were backfills from the previous half. 8 of those were in EMEA, so we're very proud that they were able to come on board and get productive very quickly and help that team have a turnaround. We hired 16 net news. Those were in both our channel as well as in our direct sales environments. We've added 3 patents or patents pending to our portfolio in the period, so we're pretty excited about the moats we continue to build between ourselves and potential competitors. We have opened in Singapore and China. As we said, we've invested in some of our regional offices, buying them back, and we had the final disposal of the Regenesis digital care business in September, finally exiting that business. Now I'm going to pass it over to Chris to start going over through some of the high-level financials.
Thank you, Pat. I'm going to start by talking through some of the key profit and loss highlights for the periods. As Pat said, we've had good performance at the invoice sales and the revenue line, both growing at 43%. This is really strong growth for the business, and I'm going to come on the next slide to talk about how that growth breaks down. At a profit level, we've also seen a good increase in the profitability for the group. There is an impact of an improvement on the gross margin line, coming through from 89% in the prior period up to 97%. This uptick is for 2 main reasons. Firstly, the prior period had a cost of goods sold associated with the Excalibur Diagnostics product. This has now been acquired, and that cost of goods sold has been eliminated. Secondly, we've seen a shift in the mix away from professional services and more focused on license sales, and the cost of sales associated with the professional services has also declined in this period. We're reaffirming the group as a very high gross margin business with a lot of the sales that we're making dropping through to the profit line. The increase in profit is also showing good growth in the adjusted earnings per share, growing from absolute profit growth as well as the cancellation of the shares in the prior period, which has reduced the overall share base. The next slide shows the detailed profit and loss. Overall, we've seen good growth in the business, although it has been a period for investing. The Eurasia revenue growth has been 25%. On an underlying basis, stripping out the currency, there's been a slowdown from what we've seen in recent periods. This is largely due to a slowdown in the sales hiring that we've seen across the business. Steve Holton, our Chief Revenue Officer, came on in July and has spent the first half in focusing, building out his sales team. He's got 17 new heads on his direct sales team and 5 on the new indirect sales team as well. Coming into the second half of the year, we're now up to capacity and we expect to see this investment pay back in the second half. On the diagnostics business, we're consolidating these revenues for the first time, 1.8 million for the period. On a like-for-like basis, in the comparative period, the business did 600,000 of revenue, showing good growth in this period. This is largely attributable to the US mobile carrier contract that was won in May of 2016. That's contributing a large proportion of these revenues. Alongside this, we acquired some new, smaller incremental business in this period, and this has helped the business move towards profitability at operating profit margins of 17%. This is lower than the core Eurasia business, which reflects that the business is still in growth and investment phase. There's been an investment in overhead cost in the business as well. This roughly breaks down into 3 key areas. Firstly is bringing in the diagnostics overheads of the Excalibur business. Second is the cost impact of the investment in the sales team. And finally is a currency impact of the weakening of the sterling on our overseas cost base. The next slide in the deck will talk through the currency impact in a little more detail. The group generates around 10% of its revenues in sterling, with the remainder being well balanced across the euro, the US dollar, the Japanese yen, and some smaller currencies. The weakening of the pound has resulted in a large benefit to the top line revenue. At a profit level, this impact has been much less severe since we match our costs against our revenues in these overseas locations, and the benefit here has been around 200,000. The next slide shows the balance sheet for the group. The profile is largely unchanged since the end of the previous period, with the largest movement being on the working capital. The absolute level of trade debtors has increased. As Pat alluded to, we have a contract down in Latin America where the cash collection has been pushed into the second half of the financial year. We expect this impact to normalise by the 30th of June. Additionally, the move towards the larger enterprise customers is increasing our debtors cycle slightly, as we're seeing more 60 and 90-day payment terms, and this has also reduced our normalised cash conversion down to the 81% level, and this is in line with our range of 80 to 90% that we expect to see for the year. Additionally, on the balance sheet, our deferred income balance has increased nicely in the period, up by 1 million to 5.7 million. And this represents contracts that have been won and billed in previous periods, but the revenue is only to be recognised in the future as the contracts are delivered. Of this balance, 2.5 is due to be recognised in the second half, and it's a good underlying trend for the business as it gives us more clarity over our contract revenues in the future. The next slide will show how some of these balance sheet movements have impacted on our cash flow. Overall, there's been an adverse movement in cash. However, the underlying generation for the business has still been positive. Absent the timing impact on the Mexico contract, we generated cash of 3 million from operations, and even after the deduction of capital expenditure and interest and tax, we have still generated £1 million of cash for the business. Additionally, there's been some investing decisions made in the half, which has reduced the cash position. First of all is the investment in M&A. As Pat mentioned, we've invested in our regional structure by buying out some of the minority interests, and this has been a total cost in the period of 2 million, including the capital cost for acquiring these shares, as well as the fees associated with getting those deals done. There's no immediate benefit to the revenue line as those revenues were previously consolidated. However, the benefit for us is that we're better able to manage the sales force in those regions and help drive growth in those places up to the amount we see for the rest of the group. The final impact on the cash flow has been the impact of the discontinued operations. These are the final costs associated with the repair services business disposed of in the prior year, and also the insurance business disposed of this year. The costs of these are substantially complete. The next slide shows the impact on our trading cash flows and our cash conversion. On a normalised basis, we are at an 81% cash conversion. This is lower than the previous period, and this largely reflects the mix in customers towards the larger enterprise deals. The other impact on the trading cash flows is our investment in research and development, which is at 1.1 million for this period. This is the investment in our teams in Finland and India, and the large increase from the prior period is due to the recognition of that diagnostics R&D team for the first time. We're going to continue to invest in these teams as we continue to grow and enhance our product portfolio, although we don't expect the growth to be as fast as the growth in the top line revenue. I'm going to pass back to Pat to talk through some of the operating KPIs for the group.
Thanks, Chris. I'm going to walk you through some of our KPIs. We're going to start with our renewal rates. We are up 1% from the previous reporting period to 92%, and we continue to improve that. You'll see that our renewal rate on currency renewals was up at about 101%, down a bit, but it should normalize at around 110% on the year. Towards the bottom, you'll take a look at what we refer to as our ARPU. These are our sweet spot customers. We define them as those spending 10,000 euros a year or more in licenses. This group ticked up again very nicely, largely because of the larger deals we've been doing and the volume of larger deals. We finished the December averaging £59,000 a year for the group, up from £48,000 the previous year, up 24%. When we look at the product sales, our active data ratio is one of our new product ranges. That is continuing to grow and grow nicely. It is a bit lumpy as they're larger data center style transactions, so we're very proud of that. We said earlier the mobile business grew at 44% in constant currency. There are 1.8 billion phones changing hands this year, and we want to be as big a part of that as we possibly can. Our end-of-life erasure grew at 4% in constant currency. If you peel apart that, there were some professional services in that number last year. The underlying growth for licenses was 22% in constant currency, which for us is a direct indication of our ability to map to that ITAD market space, because that's similar to their growth rate. So we've done very well there. We will continue, and that will normalize on the year. If you take a look at some of the changes in our diagnostics business, as Chris said, this is the first time we've been able to report revenue on it. Big cool things are happening there. We did deploy our large U.S. carrier. In 6 weeks, we deployed to 6,000 stores across the country. We are doing now in excess of 100,000 transactions on a weekly basis, so this is very meaningful. On top of that, we've been able to add a couple new customers like Swisscom as a carrier here in Europe and Amazon India for our mobile app rebranded as a powered by Blancco solution. Again, very excited there. If you take a look at our geographies, you get a sense of some of the change in our business. As we said a year ago, we wanted North America to be a bigger percentage of our business. It grew at 51% in constant currency. We have it now as 42% of our worldwide business. Europe, as we said, grew at 21%. Asia Pac grew a bit slower in this half. We do expect that to normalize in the second half. We take a look at our positioning ourselves for growth. We are taking control of our partially owned offices, such as France, Australia, and Southeast Asia. We have recently, in this half, bought back Canada and converted Mexico to a Latin American operation. We have disposed of legacy businesses. We have engaged the channel in 3 separate formats, specifically our 2-tier distribution, managed service providers, as well as OEM engagements. So again, positioning ourselves for growth. If I look at conclusions and outlooks, under conclusions, we are chasing a $4 billion addressable market that is definitely out there. It is being aided, and we are being aided by increasing regulation and guidelines around the world, like the PCI standards, 27,018 and 40, around the ISO standards, 27,018 and 27,040, the PCI standards, the different healthcare standards around the world like HIPAA and its counterparts, and the brand new EU GDPR. It's predicted that the EU GDPR will cause the hiring of up to 27,000 data privacy officers around the world. Its impact is significant, and we're also starting to see countries act on entities who are not following through on their proper data privacy regulations. So good news happening there. We've built barriers to entry, not only in terms of the complexity of the product, also our patent portfolio, but also the certifications that we pay for around the world. We do not self-certify. We do not tell our customers that we are compliant with certain certifications. We certify against them and we spend the money so our customers can have the confidence that their technology has been erased properly. We are the absolute global market leaders in both of our technologies. We have built a solid sales infrastructure, and we continue to branch out with things like building an indirect model. And we've built a strong global team, people with experience building billion-dollar corporations. So in conclusions and outlooks, we've done strongly financially and operationally in our first half this year. We've added to our patent portfolio, and we remain the industry leaders in both of our categories. We look to a very strong pipeline in our second half, and as we said earlier, we've recommitted to our consensus growth rates, our consensus revenue rates, and our consensus AOP models. I want to thank you all for your time, and I guess this is for questions.
Great, thank you very much, gentlemen. Let's start with a question from Bruce, who in the past has had the pleasure of working with Philip Rogerson, and therefore he congratulates you very warmly on what should be a very good appointment. But he's curious, and perhaps you can explain a little, how a very heavyweight non-executive director like Philip, whose background is usually as chairman of the board, what his career aspirations are in coming onto the board of a smaller AIM-listed company as an NED. And without in any way disrespecting your new chairman's appointment, would you have thought about having Philip as the chairman?
Let me touch on a couple things here. First of all, I was not on the NOMCO. So for the deliberations, I was not a part of that. I will tell you that I am personally flattered that somebody like Philip, with his background and his expertise, would consider a Blancco as a company to be on the board of. He's not only an NED, he is the SID as well. In talking with Philip, it's just exciting to hear somebody who cares so much about the technology. There's not an ego at the door. He's just excited to be a part of Blancco and contribute to our growth and help people like me make it more successful. For the rest of it, I think you probably have to ask him, but it is a very exciting appointment, and we're flattered that he would be willing to join our board.
Okay, thank you. Ashraf has a question about the recent court case on patent infringement, which you appear to have won. Could you speculate a little bit in the future as to whether this is now a set precedent and there are likely to be fewer people challenging your patents, and what are the implications for cost? He believes this case might have cost you £500,000 in defence this time. Maybe he's incorrect on that.
Thank you. You're way over on that one, so that's good news. We did not spend anywhere near that amount of money. Great IP protection attorneys and a team we've worked with in the past. Look, IP protection is a big deal. We continue to add to our patent portfolio to keep people from getting into our space and competing with us, where we've clearly spent a lot of money inventing technology. Do I think people will come after us? My thought is, it's our responsibility to make sure that people don't tread on our toes, and we will defend our IP vigorously. We don't wake up every day trying to find companies who are, but when we think people are violating it, we will certainly be approaching them. That's about what I can say on that.
Okay, thank you. Now Maria has a question for an American amongst us. Could you give her some context, as it seems for once in the world of technology that Europe might be a little bit ahead of the States, particularly in respect of legislation on data protection, whether you see the US catching up rapidly, and indeed looking much longer term for Blancco, would that rising awareness in US industry mean that there is a logical conclusion for a vast US infotech corporate to see Blancco as a takeover target and therefore an easy route into a large and fast-growing market?
Wow, that's a big question.
You can take your time over that
I
one.
might have to take my time over that one. If I can have you repeat the first part, because
What pace do you think the US will catch up in terms of legislation?
So there are a couple things. You're absolutely right. The EU has been more aggressive with data privacy legislation forever. Places like Germany led with some very tough regulations, and now the new EU GDPR has put some very aggressive lines in the sand around many things, not the least of which are things like digital data destruction, which are called out in 4 different ways within the EU GDPR. Now, its impact as to the U.S.'s likeliness to be impacted or to catch up. Its impact is global. Anyone doing business in Europe with more than 250 employees, whether you got an office there or not, subject to their regulations, and you're also subject to their fines, which I understand right now to be something like 4% of your worldwide turnover, or 20 million euros. It's getting businesses' attention, and people need to be compliant with data privacy laws when they do business with people in Europe. I think that's good news. The other areas where we're starting to see legislative impact, and we'll do our best to influence them appropriately, are in the highly regulated industries, which clearly the U.S. has a lot of. So banking and finance, healthcare, telcos, public sector, those are places where digital data destruction, there are pieces of legislation calling out for it specifically. So we do see things coming there. We do see it happening fairly quickly, but never quickly enough for us. The last piece. Are we a takeover target? I can't even talk to that really. What I can talk to is our desire to grow and grow fast enough that we're on the radar of all kinds of companies around the world, because we see a lot of these guys as potential delivery partners. Big companies have access to big corporations and these highly regulated industries that we don't have. So hopefully they're taking notice and they make us partners, and who knows what the future brings.
Okay, thank you. You talked about the changing nature of your client base and the larger enterprise clients and contracts that are coming through. Firstly, I suppose for you, Chris, could you just repeat, which I think you did, that the second half will see more of a normalization in cash conversion rates, and would that also mean to a normalization of debtor days moving back below the 90-day mark?
Absolutely, yes. We definitely expect the cash conversion to come back towards more of the 80 to 90% mark. On a normalised basis, we were at 81% for the period. When the timing difference in this contract in Latin America reverses, we fully expect to be in that range for the full year. The impact on net debt we think is going to be positive. This will give us good cash generation for the trading business, and the one-off impacts that we've seen in the first half we do not expect to repeat to the same extent, and we're guiding to a much improved net debt position for the end of the year.
And the DSOs we expect to be back to a more normalized level?
Yeah, the debtor days we expect to be to a much more normalised level. So again, absent the Latin America contract, we're trailing at around 60 days for the first half. This is a little higher than we were at the June year end, and this is largely the mix towards the larger enterprise customers. We clearly intend to sign up more of those customers into the second half, as it's great revenue for our top line. So I'd expect the debtor days to remain around that 60 level for the second half.
Great. And then extending that for you, Pat, Jake is therefore hopeful that you would walk away from large contracts if the payment terms and delays are too onerous in your view.
Yeah, we do one of two things. You either don't do the deal, or you negotiate more aggressively for terms that protect you. Part of these are growing up pains. It's a little embarrassing, but it is what it is, and we'd rather just call it out and talk to it. So we'll be more aggressive at protecting ourselves.
Okay, more of a comment, I think, from Roger about there has been some board buying of shares in the last 24 hours, with the shares having seen some profit taking after a very good run. Is there anything you can comment on about whether, you can't really say if that's going to be extended, can you? But perhaps comment about general board support and equity participation?
Yeah, I think in this last week you saw 3 board members acquire shares. Philip came on and bought some shares. I know that Tom Skelton bought shares, as well as did Rob Woodward. So we're very pleased that the board is showing their continued commitment and signaling that to the market.
Right. Moving on to marketing, the growing use of indirect routes to market seem a very sensible way to grow revenues rapidly without making a large significant further investment in your self-selling resource. We've got a question from Al. Dell is a fantastic joint venture partner to have started with. Would you expect another marquee tie-up in 2017?
It's certainly our goal is one more of those this year. We're under progress with one right now. There are a couple clearly in the pipeline, and we manage those and look at them on a weekly basis. So it is 1/3 of our indirect model, and we think it's probably the future most valuable portion of it. If we work well with our partners and they can expose us to their customer bases, it's a great growth opportunity. So we are very excited about it.
I might follow that up with a question from James. Just to get a feel for how your costs may grow in the future, relative to high growth in revenue. Specifically looking at the sales team, and it sounded from what you were saying as if a lot of the heavy lifting has already been done, and also in terms of how you see R&D costs on a 3-year view.
Great. 2 things. Let's talk about the sales force. We have largely added what we needed to for the foreseeable future. We've made a bit of a shift. These hirings include channel and OEM reps, as well as some of the direct reps, so we're very pleased about that. We're only intend to add 7 or 8 positions in the whole company in the second half. And those aren't necessarily sales. So we've got the sales team on, we've got them trained, we're getting them productive. We don't see a net increase really in the sales team. When we talk about the R&D, our R&D is very leverageable. We have 2 development centers, one in Pune, India, and one in Joensuu, Finland. We have a smaller one in Tampere, Finland as well. These are very stable environments. We continue to innovate without having to add to R&D at the same rate that we're trying to grow revenue. And I think if you look at it versus comparables, which would be maybe NASDAQ traded public InfoSec companies, you see that our R&D line is significantly lower. We get a lot done, and we maintain great products, plus we're still innovating. So we feel very good about not having to grow that line anywhere near the pace of our top line.
And James had a couple of other questions relating to the Mexican government contract. His first one was, what would you have done if it hadn't settled? Well, it sounds like it's all under control and cash coming in anyway. Perhaps more interestingly, a contract over £2 million size compared to your average 59,000. Could you speculate whether the Mexican government might be an ongoing or recurring client? Or is it going to take an awful lot of smaller contracts in the region to replace that scale of revenue?
So a couple things. Can I tell you what the Mexican government's going to do? No. But
nor can Donald Trump.
Nor can Mr. Trump, apparently. Look, the transaction, we've done a lot of business with the Mexican government. Why? Because they're one of the most aggressive at digital data destruction policies around their data centers and around data in general of any government in the world. And they're driving these programs to get themselves to that sanitized state. And then there's a bit of maintenance. For example, in December, we saw a nice, large 6-figure transaction that was a repeat. So once they get going, there is a bit of repeatable revenue. But I'm not so concerned about it. We do have a very strong pipeline that's well in excess of the types of multiples that we need in order to deliver our number.
Great. Then maybe just time for the last question, looking forward a little bit, perhaps not too far forward. But in the greater scheme of the broader Internet of Things, Leon has read about a lot of excitement about the automotive industry and the data that is captured from mobile usage there. Could you put your views into context there, Pat?
Yeah, I love that softball. That's literally one of our favorite subjects. When we released our 3-year strategy, we talked about not chasing every shiny object. And there were a lot of things that were involved with IoT. We've used third-party consultants to help us understand the potential value of some of these IoT projects. in terms of the volume of devices, the cost of developing, the proper erasure software for them. And most of them don't hold water. The one that clearly does is the automotive industry. And here's why. Last year, there were 60.4 million cars either resold or rented around the world. Every time you sync your phone with these cars, it's taking all your data. It's taking your phone, it's taking your photos, it's taking your contact details, it's taking your GPS locations, and in many cases, it's taking your web browsing. It's taking everything from your phone. And when people start to realize this, we believe that their willingness to pay $10 infotainment system sanitize when they sell their car is a de minimis expense on a $20,000 sale, and clearly a good idea when you know how much your personal data is going with that automobile. So we're pretty excited about that developing. We're trying to build a prototype this year so we can take it to revenue next year and get it. It's a lot more lucrative on a per device basis than it is, mobile phones or Apple Watches or even laptops. The future is very bright there. If you think about the rental car community, wouldn't it be nice when you get done on a rental car and you've synced your phone and you're exiting it to be able to touch a button on the screen? So yes, I'd like to erase my presence here. Maybe they $8 to your rental car bill, but you know that you're clean and you get an email report proving it. So we think that this market's going to develop nicely. There is risk for the auto remarketers in the world. There's risk for the rental car companies. Think about this. Think about EU GDPR. It says you can't take personal data across international boundaries in Europe. What happy guy gets in a rental car in Germany, and he's got 5 people's personal data, and they take that car into the Netherlands. They've just violated EU law. There's an opportunity here, and we're pretty excited about it.